Hi everyone! Markets closed on an optimistic note last week as traders were encouraged by the US non-farm payrolls. Market participants welcomed the news on rising wages. It means that consumer activity remains robust, even in the back of sky-high consumer prices. This information reinforced both stock indices and the US currency. The US dollar index, which measures strength of the US currency against a basket of 6 rival currencies, remains not far away from 107.10, the 20-year peak conquered earlier. The index closed at 106.90 on Friday. As the employment growth in the US was stronger than expected last month, investors resumed speculations that the Federal Reserve would need to raise interest rates even more aggressively. Besides Christopher Waller and James Bullard, both the voting right and the Federal Open Market Committee, said that they advocate for another rate hike of 75 basis points at the next meeting. Elsewhere in the world, other major central banks also pursue aggressive monetary tightening. This global trend raises concern about a looming downturn in the global economy. Thus, investors revised their portfolios in favor of the US dollar as a safe haven asset. Traders speculating on the euro incurred heavy losses last week. The single European currency slumped 2.28% against the US dollar, rapidly heading for the parity level. Investors were worried about gloomy economic prospects in Europe. Indeed, Russia could terminate its gas imports to Europe that will push the European economy into recession. The Nord Stream 1 pipeline will be shut down for the annual technical maintenance from July 11 to 21. Market participants have a premonition that it will not be restarted at its full capacity. It goes without saying that under conditions of an economic and energy crisis, the ECB will hardly venture into aggressive monetary tightening, despite soaring inflation. Traders speculating on the pound sterling are more confident. The British currency lost a modest 0.56%. This is how traders responded to the news on the resignation of Prime Minister Boris Johnson. It means that the fourth leader in the last 6 years will stand at the helm of the British government soon. Investors are full of hopes that the new cabinet will give priority to reducing taxes and expanding budget spending with a view to improving the relations with the European Union. The crypto market revealed signs of cautious optimism. Bitcoin managed to break above resistance of $20,500 and print a fresh 3-week high. On the flip side, the crypto trading platform Celsius was accused of a large-scale scam. The firm allegedly practiced the Ponzi scheme to hook new investors who were lured by elevated interest rates. So, newly invested funds were used to pay gains to clients who earlier joined the scheme. Last week, oil traders had to deal with higher volatility in oil prices. The market sentiment was dampened by fears of limited energy demand in the face of a looming recession. Besides, China again reported on new coronavirus cases. This information sparked concern that the top energy consumer might reimpose restrictive measures. In other words, the oil market is likely to develop the bearish trend this week. The gold market is also hit by sell-offs. The precious metal closed on Friday with weekly losses of 3.7% at $1,740 per troy ounce, the lowest level in 10 months. Gold logged the worst dynamic in the last 8 weeks. The reason behind the bearish trend in gold is the stunning rally of the US dollar and rising yields of US treasuries. It means that investors are flocking to the safety of the greenback and treasury bonds. These are the trends of the last week. We will continue following events and share the information with you in our daily news reports. Stay tuned. See you soon.